This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
Ready or not, here comes Alibaba, widely expected to be one of the biggest IPOs ever. But what made the company such a success in China?
The mouse that roars. Disney blows past Wall Street earnings expectations. What's driving the results, and what's the one key takeaway for investors?
Shifting focus, Merck sells its unit that makes well-known brands like Claritin and Coppertone. Is shedding assets part of the company's new strategy? All that and more tonight on Nightly Business Report for Tuesday, May 6th.
Good evening, everyone. Open sesame. Alibaba could soon be spreading some magic on Wall Street, or at least that's the hope. The giant Chinese e-commerce company filed paperwork with American regulators this afternoon so it can sell its shares here in U.S. markets. Alibaba has been often described as China's Amazon, eBay, and PayPal, all rolled into one internet powerhouse. It could be the biggest IPO since Facebook went public 2 years ago. John Fort joins us now to tell us more about Alibaba. So, John, I know you've been poring over these hundreds of pages about Alibaba. What new do we know about this company? How big is it? And how might it change the whole internet world now that it'll be a public company?
Well, Susie, one of the things we know is that their ambition is they really want to serve China primarily. So a lot of people are wondering, well, do they want to expand to the U.S.? Are they interested in going global as a consequence of this IPO? At least based on what they say here, they're still focused on China. Now, the value of the goods sold, they're an enormous marketplace, nearly $250 billion worth of goods flowed through Alibaba's platforms. To put that into perspective, that's twice as much as Amazon, 4 times as much as eBay. And they're a huge player just in China. If you look at the mobile transactions, the value, say, out of every $4 worth of transactions done on mobile, Alibaba gets 3.
Mm-hmm. That's amazing.
What do we know about, if anything, more about how valuable this company may be? You just gave us some numbers that would indicate that Alibaba is going to be 4 times as valuable as Amazon.
Well, we don't know that. They have kind of a placeholder number in here as far as how much money they want to raise. They say $1 billion, but we know that changes over time. And their business model is different from eBay's and Amazon's. In terms of revenue, $6.5 billion in revenue for the last fiscal year. That's not a huge amount of revenue.
That is much smaller, much smaller than either eBay or Amazon.
And it's because their model is a patient model. They're taking less money off of each transaction, but they're touching so many transactions in China. And their pitch is, China's not like the U.S. There's not a lot of physical retail properties. It's really happening digitally, and we are a huge part of that happening digitally in China.
Real quickly, I know in this prospectus, in this filing, they didn't say anything about what the shares might be priced at, but that's the number everybody is wondering. Do you have any clue of what it might cost to own a piece of Alibaba?
We don't know exactly how they're going to divvy that up. That's going to change right up to the last day. We don't know, but it's probably north of $150 billion, the total value of the company once it goes IPO.
Okay. And what's it going to do to Yahoo? It's going to boost the value of Yahoo, right? Because they've got 24% of it.
It could be good. Right now, a lot of that's already priced into Yahoo. We'll see where it goes from here.
John Fort, thank you. So why is Alibaba so successful in China? For one thing, it operates a number of businesses, including the Taobao marketplace, one of China's most visited online shopping sites. And as Eunice Yoon reports, Alibaba has changed the way Chinese consumers buy almost everything.
Zhou Li is a self-described addict of China's online shopping site, Taobao. Nearly everything he buys now is bought on the virtual bazaar of soon-to-be-listed e-commerce giant Alibaba. He's on Taobao multiple times a week, purchasing furniture, his guitar, and today, food for his cats.
Taobao changed my lifestyle.
Taobao is a national obsession in China. In a country where consumers still mainly save, when they do shop, many log on and browse here.
On Taobao, which means search for treasures, you can buy an outfit, try it on, and hand it right back to the delivery man to have it returned. You could also buy something worth pennies and have it delivered right to your door. Millions of these packages are shipped out across the country.
You can easily find some stuff which pretty hard to get from the local supermarket or local shoppers.
Today, Li's cat food is coming from a warehouse across town in Beijing. This retailer, one of Taobao's 7 million, used to have a proper pet food store, but switched to sales online.
从客户来说比较广。
We have more customers with our online shop. They're all over China, not just limited to Beijing, he says. It's good for business. Li got his cat food in less than a day after paying through Alipay, Alibaba's version of eBay's PayPal. The payment system is one of China's most trusted, though buyers and sellers say they hope Alibaba builds faith in its sites even further by cracking down on the sale of fakes. Even so, Li is still using Taobao for all his needs. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Despite all that excitement about Alibaba, our next guest says the IPO market is going through a reset. She's Kathleen Smith, co-founder and chair of Renaissance Capital, an IPO investment advisory firm. So, Kathy, I know that you've been saying that this is a harsh environment for companies that are going public, but you just heard the news about the Alibaba filing. Could that company be the exception? How do you think it's going to do when it goes public this summer?
Well, we do think that Alibaba could certainly break the code that we're seeing in the IPO market, which has been a pretty harsh environment where since mid-April, the deals that have been priced, the last 70% of them have been priced below the range. So issuers have not been treated very well in the current IPO market. And you know, there's a lot of investors want to see high growth companies, but they want to see profits. Alibaba has profits, so that's going to be an IPO that will be looked at and of interest, we think, to the IPO market.
So would you expect that it will buck the trend of those numbers that you just said? In other words, 70% falling below the forecast range?
We think so because you can look at Alibaba and actually put a multiple on their earnings and come up to maybe a valuation of that $150 billion. So that is going to make it a little easier to value. And I think almost every portfolio manager is going to want to own this company, which will be the world's largest e-commerce company.
You know, back to the overall IPO market, it was really strong in the first couple of months of this year. And then just recently, the last couple of weeks, it's really gone kind of soft. And we've got a lot of companies going public this week. And in fact, there are a couple of them that are Chinese companies as well, Cheetah Mobile and Tunia, which is sort of a Priceline type company. How do you think these companies are going to do this week?
I do think investors are going to be very selective about these, and there'll be some pricing pushback, particularly the ones that aren't making money. And I do think that there's a focus on the very largest, most valuable internet properties. So I do think it may be harder for this large backup of IPOs that we're seeing to get done. This is actually a good thing for the IPO market because we need the IPO market to work for investors. And that had been the case all the way through about the first quarter. But the second quarter, it has not been a profitable place for investors. And so the prices have to adjust downward. And then investors will make money. That's how it works. That's a good thing.
What changed and why?
Well, if you look at the overall market, all the high growth, particularly non-earning high growth tech and biotech healthcare companies, had a reset in their valuations. Many of the internet companies are down 20 to 30% from their highs. That had to affect IPOs because IPOs are priced relative to the already traded companies. So investors there's institutional investors and they need to have the logic in where these prices are trading. They just can't trade. Trees don't grow to the sky.
All right, so give us your quick outlook in half a minute of how you think the IPO market will end the year. 140 IPOs so far this year.
Well, we had been very optimistic till about the last month, but we think we could get to above average levels of 250 or so. We're going to go through a slow period now, but I think that once this adjustment's made, we'll see the IPO market come back to more normal levels.
All right, Kathleen, thank you so much for coming on the program. Kathleen Smith of Renaissance capital. And here's something Twitter probably won't be tweeting about. 6 months after it first went public, the company's lockup period expired today and shares took a tumble. Today is the first time that company insiders and early investors were finally allowed to sell shares they own in the microblogging site. And apparently a lot of them did. Shares of Twitter tanked, falling nearly 18%, but shares are still higher than November's IPO price of $26 a share.
On Wall Street, stocks sold off right from the opening bell as disappointing earnings from the insurance giant AIG weighed on financial shares, and sell-off in Twitter that Susie just mentioned impacted other internet and social media stocks. More on that in a moment. The Dow, when all was said and done, down about 130 points, NASDAQ off 57, and the S&P lower by about 17.
After the closing bell, Dow component Disney delivered the highest quarterly earnings in the company's history. Disney did it with people flocking to its theme parks to escape this winter's bitter cold and snow, filling theaters showing its blockbuster animated movie Frozen, and turning to ESPN, the ABC network, and all of its other TV holdings. Here's a look at today's numbers. Disney posted earnings after charges of $1.11 a share. That was 15 cents more than analyst estimates of 96 cents. Revenues also beat forecasts, topping $11.5 billion. In after-hours trading, Disney shares rose as much as 2%. They were down a fraction in the regular session. Here's Morgan Brennan with more on those Disney's results and the key takeaway for investors.
Mega blockbuster Frozen has been getting all of the attention when it comes to Disney, and with nearly $1.2 billion grossed, certainly the main driver of growth in the company's studio division. But the bigger story is that all 5 of Disney's main businesses, so media and networks, parks and resorts, studio, consumer products, and interactive, all grew strongly. Each one posted double-digit increases in operating income, contributing to the highest quarterly earnings per share in the history of the company. And at $1.11 per share, that blew away analyst estimates of 96 cents. Even the company's smallest unit, Interactive, which had been losing money, is now logging a profit, thanks to its Disney Infinity video games and toys. For Nightly Business Report, I'm Morgan Brennan in Los Angeles.
Wide array of offerings and key acquisitions have helped Disney make the mouse that roars, riding big wins at the box office, in home entertainment and theme parks, to upside surprises in every quarter over the past year. And we took a closer look at what makes Disney such a darling for investors.
Start with Frozen, which Disney certainly isn't. It's the highest grossing animated feature film ever. The movie crossed the $1 billion mark in box office in March, just 4 months after it was released. Frozen, along with Thor: The Dark World, has income at Disney Studio Group skyrocketing. Overall box office take since January of 2013, more than $2 billion. Thor is part of Disney's Marvel unit, where the hits just keep on coming. Captain America: The Winter Soldier just made Marvel the most successful movie brand of all time, eclipsing Harry Potter. Who's third? Well, Disney's own Star Wars, of course.
You could argue that having all of these different brands under their wing, they have a veritable Mount Rushmore of huge movie brands at their disposal.
Gamers made Disney's Infinity the most popular hybrid toy and video game since its launch last summer. It's done so well, they recently announced Marvel's superheroes will be getting together in a second edition.
I think this company could be in a golden 2 or 3 year period. It's just going to be a great 2 or 3 years for the company, and I think the stock has maybe 30–40% upside over that period.
The other pieces of the Disney empire have also performed during the past 4 quarters. Theme park attendance, new records, and the media networks also made more money. ESPN is still the single biggest piece of the Disney machine, accounting for 30% of the company's total value. The sports network had higher ad revenues, and it is still, by far, the most expensive cable channel for operators to provide to their subscribers. Those operators also had to pay higher fees to bring the Disney Channel to their customers, making Disney, indeed, the mouse that roars.
Well, the roster of companies Disney's has under its umbrella looks so strong right now that some analysts are saying it is positioned for success that could last decades. Still ahead, Merck enters into a mega deal selling its consumer unit for $14 billion. Will there be more to come as the drug maker shifts its focus?
Here's what the new interim CEO at Target said on his first day on the job. Investigators have determined that last year's massive data theft has been limited to what the retailer has already disclosed: 40 million credit and debit card numbers and personal data from 70 million other customers. John Mulligan, who was thrust into the top spot yesterday when longtime CEO Greg Steinhoffel was ousted, also says he's not interested in becoming Target's permanent CEO.
Another huge deal in the pharmaceutical industry. Merck finalized its sale of its consumer health division today to Germany's Bayer, selling off popular brand names like Claritin, Coppertone, and Dr. Scholl's foot care products. Despite that $14 billion sale, shares of Merck were the biggest decliners in the Dow today. They were off 2.5%. Meg Terrell was at Merck's Analyst Day up in Boston, where she spoke with the drug maker's CEO about this latest deal and what's next for the company.
Merck today announcing it's selling its consumer over-the-counter health products business to Bayer for $14.2 billion. We talked with CEO Ken Frazier here at the company's Analyst Day in Boston. He told us this is part of a repositioning of Merck's business to focus on the areas where it can be a leader, but that reshaping isn't done and we could potentially see some more.
We're going to look for the best growth opportunities within that portfolio. So I wouldn't say we're finished. We're going to continue to evaluate opportunities to create value. That's to buy things that will make sense at a value-creating opportunity, to sell things that we don't feel are core, and of course, to keep and build on certain things.
Now, Frazier also highlighted some pipeline opportunities the company has in areas like cancer, hepatitis C, HIV, diabetes, and Alzheimer's. We also talked about U.S. corporate tax policy. This, of course, against the backdrop of Pfizer's $106 billion offer for AstraZeneca. Pfizer has said it would potentially reincorporate in the U.K. to benefit from the lower corporate tax rate there. Ken Frazier telling us today that U.S. companies are at a competitive disadvantage when it comes to business development because of the U.S. corporate tax rate.
I actually think that we need to lower the tax rate. I think we need to have a system that is a territorial system or a hybrid system. And I think we've got to recognize that we're in a global war for assets and we're in a global war for business. And U.S. companies can't be at this kind of disadvantage.
Now, Ken Frazier today also focusing on the company's cancer drug, which has gotten an accelerated path forward at the FDA. And we should see more data on that in an upcoming cancer meeting called ASCO at the end of this month. For Nightly Business Report, I'm Meg Terrell in Boston.
Whole Foods reports a miss on the top and bottom lines, and that's where we begin tonight's market focus. The grocer said same-store sales rose 4.5%, but that number trailed estimates. Whole Foods also lowered its full-year sales forecast, and that's after it already trimmed its outlook the past 2 quarters. Shares initially plunged after the report. The stock was down a fraction in the regular session to $47.95. Well, it was the opposite story for Electronic Arts. The video game maker reported its profit jumped about 14% on better than expected sales of new consoles. It also announced plans for a $750 million share buyback. To top it off, the company raised its full-year guidance. Shares surged after hours, up as much as 14%. During the regular session, the stock was down 2.5% to $28 and change. Groupon reported a quarterly loss, but it wasn't as bad as analysts were expecting, and revenue also came in better than expected. But the online deal site issued a light second-quarter profit outlook, so shares initially fell after the bell. During the regular session, the stock was off by 2.5% to $6.72. Pandora's listener hours were up 30% in April. The streaming internet radio company also saw its active listeners increase to 76 million people last month. But investors just didn't seem impressed. Shares tumbled about 9% to $22.52. Tyler?
Office Depot closing 400 of its stores in the U.S. over the next 2 years as its merger with Office Max led to an overlap of locations. It says the closures will save the company $75 million a year by the end of 2016. The office supply chain also posted better than expected quarterlies. Shares up 16% today to $4.83. Shares of Delta took off after the airline announced it will hike its quarterly dividend 50% later this year. The company also launching a new stock buyback plan to increase returns for its shareholders. The $2 billion buyback will be completed by the end of 2016, and the stock rose a fraction today to $37.69. Shares of Corinthian Colleges plunged after the company said it is exploring its options and reported weak results. The for-profit education company, which is struggling because of declining enrollment and regulatory scrutiny, says it's going to be working with an investment bank and possibly putting itself up for sale. The stock fell more than 9% to $1.08.
The newly merged Fiat Chrysler unveiled an ambitious 5-year plan today. Among the goals, the automaker wants to more than double sales of Chrysler and Jeep vehicles by the year 2018, while building 6 more Jeep assembly plants in 6 different countries, including China and Brazil. It's also aiming for a boost in worldwide sales of Dodge and Fiat cars and targeting explosive growth in sales of Alfa Romeo sports cars. It plans to unveil 8 new models over the next 3 years. And coming up on the program, a new report concludes climate change is already disrupting our economy and comes ahead of new regulations that could impact certain industries. We have that story next.
Lawmakers in Washington taking on high-frequency trading, trying to determine whether the U.S. stock markets are rigged and how regulators can police that high-speed trading. Senate panel will hold a hearing next week on the use of complicated high-speed computer programs and automated systems that critics say give some traders an edge over average investors.
Also in Washington today, the Senate Banking Committee will vote on a bill to overhaul the U.S. housing finance system next week. The proposal will wind down bailed-out taxpayer-owned mortgage giants Fannie Mae and Freddie Mac and look to shift more home loan guarantees toward private lenders.
The Obama administration releasing its latest assessment on climate change, a 3-year study with input from hundreds of scientists, engineers, government officials, and other experts on the impact of global warming. Our Hampton Pearson took a look at how climate change has already affected business and the overall economy.
The latest National Climate Assessment says extreme weather caused by climate change is damaging the economy and impacting the lives of Americans in every part of the country. In 2012, extreme weather cost the economy $100 billion, the lion's share $65 billion from Hurricane Sandy. This past winter, tens of thousands of weather-related flight cancellations cost 4 major airlines at least $500 million in lost revenue, according to just-released earnings report. A 3-year drought is impacting California's $50 billion agriculture economy, with more than 800,000 acres of farmland going unplanted. Also, the prospect of a big spike in produce prices on the way at the nation's grocery stores. At the White House, President Obama was enlisting the nation's weather forecasters as part of his latest call for action.
We want to emphasize to the public, this is not some distant problem of the future. This is a problem that is affecting Americans right now, whether it means increased flooding, greater vulnerability to drought, more severe wildfires.
Environmentalists are praising the report because it pins much of the increase in climate change on human behavior, specifically carbon emissions that cause greenhouse gases. But conservatives say America can't act alone.
The greenhouse gas emissions from the United States are not that large compared to the global greenhouse gas emissions. I think the power plants are only a small part of that, and I think that the climate change going into the future is not going to be as dire as it's made out to be.
The report rollout comes just ahead of next month's release of new regulations from the Environmental Protection Agency limiting carbon emissions from existing coal-fired power plants.
We can do this. This is not about frightening people. It's about facing realities that we face today and taking action to protect our kids in the future.
But on Capitol Hill, Senate Republicans continue to push for a vote later this week on approval of the Keystone Oil Pipeline as both the job creator and environmentally friendly.
We need the Keystone XL pipeline, which will create tens of thousands of new jobs. It will mean we have a safe source for additional oil in addition to what we produce here in America.
It's not just Congress that's stalled on energy policy and climate change. The latest Wall Street Journal NBC News poll finds climate change at the bottom of voters' priority list, with about 40% of those being surveyed saying action could be delayed until next year. For Nightly Business Report, I'm Hampton Pearson in Washington.
Here's a man with quite a story to tell. Ben Bernanke, the former chairman of the Federal Reserve, he sealed a book deal. The book, currently untitled, will be published by W.W. Norton and will tell the story of how he guided the central bank and the economy through the financial crisis. No terms disclosed just yet. The book is scheduled to be released next year.
And finally tonight, a dubious anniversary to note on Wall Street today, one that introduced a lot of people to high-frequency trading and the flaws it exposed in the markets. On this day in 2010, the New York Stock Exchange suffered what became known as the flash crash. The Dow suddenly plunged nearly 1,000 points late in the trading day, losing 9% of its total value in just minutes. By the end of that session, stocks recovered most of those losses, but the debate about the pros and cons of super fast automated trading program rages on.
It was a frightening day.
Yeah.
You felt that everything was out of control, but of course the computers were controlling it.
It was the whole fat finger thing.
The whole fat finger, and Procter & Gamble going down $20 a share was crazy.
That's Nightly Business Report for tonight. I'm Susie Garrow. Thanks for watching.
And thanks for me as well. I'm Tyler Matheson. Have a great evening, everybody. We'll see you back here tomorrow night.
I'm Susie Garrow with a Nightly Business Report news brief. Chinese e-commerce giant Alibaba filed paperwork to begin selling stock in the U.S. It's hoping to raise $1 billion, making it the biggest IPO since Facebook. Meanwhile, another hot internet company stumbled today. Shares of Twitter plunged 18% on the first day the company insiders were allowed to sell stock they own. On Wall Street, stocks sold off sharply. The Dow lost about 130 points, the Nasdaq was down by 57, and the S&P was lower by about 17 points. Disney posted the strongest quarterly earnings in its history, thanks to the strength of its theme parks and the animated movie Frozen. And Merck sold brands like Coppertone, Claritin, and Dr. Scholl's to German drug giant Bayer for $14 billion in cash. Be sure to tune into Nightly Business Report right here on your public television station.